Today we'll be talking about the cryptocurrency crash. Before anyone say like, oh, you're just covering it now that, as it happened, like you didn't see it coming kind of thing. I posted a video in February 2021 mentioning that crypto is a Ponzi scheme. And so I saw it quite well ahead. It's just, it took time. I was early. It took time for it to kind of all unfold. And I also thought this quote was kind of funny from 2008, where they mistook leverage for genius. So this is going to be one of the factors that have contributed to this whole crypto crash. And I'll also be talking about some other topics. To start off with executive summary, so in terms of the dollar index, DXY, I'm again expecting it to be bearish. In the short term, it remains strong, but it is showing some signs of weakness. One thing being the euro is strengthening as ECB is also starting to tighten. And also, the only thing that is still supporting the US dollar index is really the yen continue weakness. We don't know how long that's going to continue, but again, a bigger part of the dollar index is made up of euro. So as euro strengthens, as ECB have to try to take control of inflation in EU, there is a downward pressure in terms of the dollar index, and also in terms of a long-term fundamental side, the twin deficit continues. Next up, oil. So it looks like it's starting to have a false breakup where it went up to 120 and then now it's sharply declined right up to 110. So this is something that I have been anticipating, but we'll see. One of the bigger reason is because Biden's midterm election is coming up, and he has a lot of pressure to bring oil prices down in order to help, his mid-election case. And he is meeting with Saudi in July, and Saudi at the same time also announced that it's lowering export to China, which China can probably just buy from Russia, as Russia's not shipping as much to EU, at least supposedly. And also US is also trying to push for more domestic supply in terms of fracking and also refining. I don't think in terms of fracking like they'll increase more wells, nor refinery, meaning creating like new ones, because these are long-term projects, and I doubt these companies are willing, like we're talking about like a 10-year payback period, and I doubt these companies are willing to go into that with, this administration specifically pushing for such, green energy narrative. And so what I think is maybe they'll just increase the usage of the refineries, and that might help in the short term. But again, long-term wise, we're lacking a lot of long-term sustainable reinvestment. And also another key point is, if we take a look at the world's population, there is, a lot of people who still don't have access to energy, and they're having more access to energy. And when poor people, when developed countries, when they increase consumption, they're buying services, goods. But when it comes to developing countries, and they're starting to get, more wealthy, they buy infrastructure. And so that will require, again, a lot of more base metals, and also, a lot of energy, because all of a sudden they're going to have access to electricity, and, what's the cheapest, most accessible form, fossil fuels. Equities, again, I expect it to continue to be bearish until Fed pivots. And, another thing is with the higher yields in bonds, that really hurts the PE valuation. Why is that? Well, if we think about it, for example, like a 10-year at like 3.2%, you inverse that, so like 1 divided by 0.032, you get about 28 PE. I can get a 28 PE ratio risk-free if I just buy bonds. So meaning in terms of equities, how much more of a risk premium am I going to get? If my PE ratio in equities are actually lower than bonds, why am I buying equities? Because again, bonds supposedly, quote, risk-free. So that's my risk-free rate of return. Why would I then, I need to expect much higher if I'm going to take on risk in equities market? And so far, emerging markets have, year to date have outperformed the US. This is something to continue to observe. I think once the DXY starts really falling, then we'll see emerging market to really be an attractive buy. Finally, for bonds, again, long term, a long way up for yields because I expect inflation to stay. But it might, again, catch a short-term break. I thought like that was it when it went down to, a slight break to like, I think 2.9, just below 3, but it's way back up above 3 for the 10-year right now. So again, we'll see. It's not something I'm interested in buying at all because, again, long-term wise, I expect yields to have a long way to go, but it is something that I am keeping an eye on. But the key takeaway this week is, again, the yield curve is again inverted. Usually what happens is the second yield curve inversion is the one that confirms the recession. Next up, let's talk about some topics we'll be going over today. So we're going to first talk about crypto fundamentals, going over the crash, and then kind of going forward why. So kind of past, present, future. Then we'll talk about FOMC meeting, what happened there, the ECB emergency meeting, and then we'll talk about how falling of yen could risk a Asian financial crisis. We'll talk a little bit about real estate, and then again cover off with commodities outlook. So now let's talk about some crypto fundamentals. The blockchain itself, I think it is a revolutionary technology. However, the coins, the cryptocurrencies, do not equal the technology. So keep that separate. It's just something to be used on the blockchain, but does not mean that it has to be viable like the technology itself. The coins are very similar in their purposes. A lot of these coins, they're different, like in name, hash rate, and sometimes underlying assets. Sometimes they don't have it. Some have USD backing, others don't. But what happens is these coins, they're very similar, very replaceable. Like, what's the difference between one to the other? Like, that's another thing because there's so many. And so what happens is it goes back to my theory before, like, in terms of a lot of the whales, if what all they have to do is they just pump one coin, right, get you in, sucked in, and then they sell, and then they go into another coin that they just created or that hasn't gone up yet, and they pump that one, and they just keep recycling. And then whenever you're like, wow, this is rigged, they just say, oh, you just don't know much about this, this market. You have to look at a bunch of other coins. And again, when it comes to a non-regulated market, and these coins are so they're so similar, there's no point. Like, the only way to not get hurt in this market, if you don't have like a big control of a lot of these coins, is just don't play. That's it. So I'm not short it, I'm not long it. I'm staying the hell away from it, but I love watching the dumpster fire. And clearly, it is not an inflation hedge. Like, so that argument is way out the window. Like, year to date is down 60% when inflation is around 8%. So not only is it not keeping up with inflation, it is way down. That's hilarious. Right now, there's just too much speculation. Like, people are not buying it thinking it's an inflation hedge. They're just buying it because they think it'll go up. That's very different. That is very different than, what an inflation hedge buying mentality would be. There's, again, no regulation, so it allows for all kinds of fraud that otherwise wouldn't be available in other markets. And some like one of the coins that blew up earlier was, for example, Luna. But again, the point is that front running, like meaning like the broker buy before you, or they sell before you sell. When it comes to insider trading, like this market is not regulated at all. So in terms of retail investor, like small investors, you can't beat the bigger guys because there's no regulation, there's no reporting requirement, there's nothing. Another thing people are talking about, limited supply, and then they always think like, the hash rate halving is bullish. That makes no sense. Why? Because what happens, I agree, the limit is, so a lot of, like for Bitcoin, for example, supply is limited to, and what happens is the hash rate is, the creation rate, if you think about it, and they say it halves. But what happens is that doesn't equal the supply decreasing. The supply is still increasing. It is just increasing at a decreasing rate. Anyone who's, taken calculus or drives a car, you know what that means. Like, for example, you're just taking your foot off the gas pedal a little bit. You're still speeding up, but the rate that you're speeding up is slower. That's it. So supply isn't decreasing when the hash rate halves. It's just increasing at decreasing rate. So that argument's out the door. And finally, like, there's no ultimate use. There just isn't. I understand, like, I'm not a fan of the fiat currency either, but at least they have a ultimate use. Well, because government expects you to pay taxes in that currency. So there is a final use other than just, means of exchange. And crypto as an asset class, again, it has no cash inflow. So people who are saying like, no, I just save my crypto with this, bank or whatever, and they give me like 8%. Just think about it in your head. How are they getting that 8% return? Well, they lend it, and they use leverage. And so what happens is you expose yourself to a lot of risk that you're not told of. You didn't know ahead of time. Because what happens is, they lend it out. That person maybe is, trying to borrow it to short it or long it, and that risk you're not privy to. And they advertise it like, there's no risk, 8% return. And, just like a Ponzi scheme, what happens is you just keep taking more money in and you pay out a bit of it. And everyone's only looking at, the return on capital, like 8%, but they never think about the return of capital. What about your principal, your 100%? Where is it now? Now let's talk about, the crypto crash. So it's not just Bitcoin that's falling, but all the altcoins as well. So this is, another thing that we haven't seen much of before, like a massive drawdown on all the coins. And there's just so many pumpers. Like they keep pumping to try to find the next fool, and I think eventually they ran out. Or the fools who are all in it ran out of money to buy more. And what happens, again, the leverage idea is coming up. A lot of them mistook leverage for genius. Like, for example, MicroStrategy, they borrowed a lot of money, they issue equity. Their cost for Bitcoin around like 20K. Well, we just broke below that. Is there a chance of margin call? Can they come up with more money? Or are they going to start selling? Because if these guys, the bigger investors, if they have to start selling to cover their margin calls, it's a downward spiral, right? Like, and another thing is I think they mistook excess liquidity for a bull market. Like, cryptos start falling when there's no longer that much excess liquidity. Meaning, so Fed printed so much money, right? Central banks around the world printed a lot of money, and then people who got these money, they're thinking, well, where should I put it? And they're thinking, crypto's going up. Let me just buy more, and it became a self-fulfilling prophecy, where more people saw it going up, more people had more extra money nowhere to put, so they put it into the market. Well, what happens is when we saw overnight RRP went way up, meaning like money is not flowing into the system, but rather going back to the Fed, because bigger players are like, okay, we know this thing is done. Like, we'd rather have the really safe, 0.25% or whatever at the Fed, rather than bringing it out to buy any asset, not even treasuries. That's why we saw treasury yields going up. And what happens is when liquidity is no longer increasing and it's shrinking, what happens is a lot of these players realize, holy cow, I don't have money. Well, what do I sell first if I need cash? Well, you sell the most speculative assets. You don't want to sell your core holdings. And so, or they just didn't have more money to pump this thing up. And some people didn't hold the line. Someone started selling, and eventually it got to the point where other people were selling, and that's it. Because again, there's no cash inflow generation in this whole asset class. And again, we saw crypto falling. It kind of leads the whole speculative asset class, like the tech stocks, your meme stocks, like NFTs. As crypto start falling, those are the assets that kind of start falling with it, because I think it's the same group of people, or people with like similar mindset, are the ones who are buying into all of this. Now let's talk about crypto going forward. Now, I expect some people will never sell, and they're the real loser, the bag holders. And if Fed pivots, I think they might catch one more bid, but it won't be unless Fed prints so much more that there's so much more liquidity, and somehow enough people are dumb enough to still fall for this, then I think it has one more bid. But again, I doubt it, because not all of the speculators, or at least their whole holding, I don't think they'll survive the downside. I don't think Fed pivots fast enough to prevent these guys from, like some of them, going bust. And once the volatility has passed, with some real asset backing, I think some coins could work, but I think most of them are just fading into the history and marking this to be like the newest and the biggest Ponzi scheme. I don't think at this stage, I don't think any of them will become viable in terms of our society usage, because, again, central banks, their power comes from controlling the currency. This cryptocurrencies, you can say they are competing. They are competitors to what central banks can control. And we already heard about, central bank, digital currencies. So there's no way central banks and government will allow, cryptocurrencies to be viable, because it's competition to what they can control. And again, they don't have to outlaw it. They just make it so hard, such a high cost in terms of compliance. Like, they start putting a lot of regulations in, and makes it so it's too costly to transact using cryptocurrencies. And there you go, it doesn't become viable. Now let's cover up FOMC meeting. So the Fed announced they're hiking rates by 75 basis points. They're looking to 1.5% to 1.75 to the policy rate. Market had like a 93% chance of the 75 basis point hike going into the press conference. So, is as expected again. So a few key points Powell mentioned in the press conference after the announcement. They're not concerned that they will cause a recession, which is hilarious, because we're already seeing that there are so many data suggesting we are already in. Again, 2 quarters of negative GDP. So we'll see. It looks like right now Atlanta Fed is already downward. They're GDP estimate to 0% from I think 1.8 previously. Looking at retail sales, you know, like I said before, retail sales, the increase in percentage has always been lower than inflation, meaning yes, in total dollar value is increasing. However, that's because prices is increasing while quantity is decreasing, meaning people are buying less and they can't afford more because prices are increasing. And in terms of, US economy, where 70% is consumption, retail sales and consumer sentiment, again, consumer sentiment is, going down as well. That is a big deal in US's economy. So another thing, like PMI, we're starting to, see potentially maybe it'll hit below 50. Inventory levels, it's really hitting really high, like I mentioned before, because 2021, a lot of people bought a lot of stuff because they all had, work from home or a lot of money spray everywhere. And, companies thought, this was a continuous process. So they ordered, they over ordered, and there were also a shortage, in the supply chain. And once that was cleared up, all the inventory came and landed. And then the company realized, oh wait, these people don't have, stimulus checks anymore. They can't buy as much. Holy cow, I have so much inventory. Housing starts and permits. So again, that's a leading indicator for real estate. I'll talk about it a little bit more, but that is also showing weakness. And Powell also mentioned they're willing to do whatever it takes to fight inflation. Meanwhile, the policy rate is 1.5% to 1.75% when inflation rate is 8+%. If they really care, just go all the way up, go 10%, 20%, like Volcker. I promise you inflation will be dealt with very quickly, but what that means is total demand destruction. And that seems like the only way they can fight inflation right now. Because again, Fed is correct that they do not have the ability to influence supply. They cannot create more, oil wells. They cannot grow more food. What they can control is demand. And so when they print a lot of money, send it all out, demand increases. That's, price increase. There's more money chasing, more currencies chasing the same good. And so that price goes up. And in this case, the only way to control inflation, because they can only control demand side, is to destroy demand. Another conspiracy theory is, maybe they're looking at China. They're like, hey, we have to fight China. The only way to do that right now is China right now is weak. They're surviving through export, and they did really well in terms of export during 2021. And now that the equities market is starting to turn, we have to stop that from happening. And the only way to do that is, again, demand destruction. Destroy your, demand. That will also solve the labor shortage, with massive layoffs. It's just ridiculous. In term, the question is, do they have the determination for total demand destruction in order to lower inflation? And part of me thinks they don't have it. Finally, Powell also mentioned that Fed normally only looks at core inflation, so ex food and energy, and the only reason is because those are more volatile. Again, it's just like, for example, you get grades from high school or whatever, and you're like, oh, my math and science is too low. They're drawing down my average. So I'll just, ignore that and say, hey, just look at my average X math and science. Well, that doesn't change the fact that your average is lower. It's the same thing with inflation. But now they're saying oh, people see inflation as inflation. They don't really care about core, or they know, or some not even know about it. the question is, does this mean that Fed will start to be concerned about inflation and not just core? Maybe they'll start targeting inflation and not just kind of like, instead of just really looking at PCE and also core inflation, they'll start, giving targets for inflation as well. I know they have pointed out, 2% is their new natural rate, but are they actually going to try to achieve it? Who knows? Another key point is, if they start to target inflation instead of just core inflation, does that mean if food and energy prices come down, will they still continue to fight instead of just holding off? So again, these are things to continue to be observed. Next up, let's talk about the ECB emergency meeting. So as discussed before, the EU economic cycle, I think, is following the US. So they're kind of lacking a few months behind. So if US is showing possibly already in a recession, then EU is probably walking into it. Previous meeting on June 10th, they plan to hike rates in July, and they're also ending QE. They're doing the same thing that Fed is doing. They're not buying more. What they'll do is they just keep rolling over. They haven't announced when they'll do QT. And then within a week, the bond market in EU just sold off. Why? All these countries have loaded up debt, so much debt, for so long, like all the negative yielding bonds, which is ridiculous. I don't know who's buying these. It's probably just, government requirement on, pension funds or mutual funds to have to hold a certain percentage so that you have no choice, which kind of pushed the rest of the portfolio into higher risk in order to make up for, negative yield. Anyways, and so what happens is, with everyone borrowed too much money and now yields, they hear that yields are moving up. They're like, holy cow, I have to get out of this market. So the bond market sold off. And so what happens is ECB comes back and says, okay, we're preparing new tools to raise for rising borrowing costs. And how they're doing that is they're going to focus for any new asset rollover. Again, when a bond matures, they're going to take the principal and they're not going to just leave it. They'll buy another one. But what happens is they'll say they'll buy, focus on countries with, government debt with really moving, rising borrowing costs. And so, this is another kind of focus bailout to whichever country is in trouble. And this is the issue that the European Union always have and always will have, is because there is no incentive for members to be fiscally responsible. Why should I work so hard in having a limited budget, having surpluses like Germany? Why don't I just, slack off, relax, just borrow, and if anything happens, ECB will come to save me. So this is the issue that they're starting to again to resurface. And the question is, is this Europe debt crisis 2.0? Last time was 2010. We'll see. So now let's talk about the Japanese yen and the risk of an Asian financial crisis. So why is that important? How does yen impact that? If the Japanese yen continues to fall, right now is about 134 to 1 USD, it hurts other Asian countries' exports, because if yen is depreciating, it makes Japanese goods, cheaper to everyone else. And what happens is then the demand for other Asian country produced goods. If, for example, let's say, instead of buying a Hyundai, I look at Toyota, be like, wow, Toyota, Honda car is so much cheaper. I'll buy those instead. And Korea's like, what? For example. And the risk is increasing again as the yen continues to depreciate. And last time, 97, we saw the height of USD to yen at 148, and right now we're at 134. So again, that's a question. Are we going to get there, right? What will happen? And right now it looks like hedge funds are shorting yen, where they're either shorting it on the forex market, or another idea is by borrowing in yen, and when it depreciates and you pay it back in a few years later, you don't have to pay back as much. And what happens is now you're able to also buy other assets with that borrowed money now. And so if that asset appreciate value and you sell it and then you repay the loan, but also you don't have to repay as much, it's a win-win on both sides. Well, like in both the asset appreciation and the debt devaluation. And then the market is testing Bank of Japan's upper limit for JGBs, Japan government bonds. And that's what we're continuing to see, because BOJ mentioned that they will buy an unlimited amount of JGBs to, keep rates from going too high. So the question is, again, what will the BOJ do? Are they going to continue to uphold their promise to keep buying JGBs no matter the price? Or are they going to switch to tightening? And that will impact the yen, and that will impact Asian markets and Asia economy. Next up, let's talk about real estate. Powell effectively said in the press conference that people who are trying to buy a place, just wait for real estate prices to fall and correct. And this is his exact quote. And as mortgage rates continues higher, what happens is, people who have variable rates, or people who are looking to refinance, or people who are trying to look to go into real estate market trying to buy a property, they're facing higher and higher monthly costs. And so what happens is, and they can't afford as much because, for example, normally you can only afford like a $500 a month mortgage payment. Well, as mortgage rates continue to go up, what happens is the price of the property you can afford goes down because the mortgage you can afford is not as much anymore. And so what happens is there's less buyer, or prices will have to come down. And what we're seeing is in US housing start and permits are down, and these are leading indicators showing that there's weakness in this market. Finally, let's talk about commodities update. Energy, again, I think there's a short-term downside risk because there's a US midterm election, and again, Biden needs to bring gas prices down because right now he's not looking too hot on the polls, and a lot of people are concerned about inflation. And another thing is summer consumption is not as high as expected. This could be due to weather, where this year it feels like it's a lot cooler. That could be in reasoning with El Nino, La Nina, with last year being really hot and dry, and this year maybe it's a lot cooler, a lot wetter. So people are not required to turn on their AC as much or as early. And so what happens is consumption is not as high as expected. But again, long term, I think oil has a long way to go. I wouldn't say long way, but I think it's still bullish. But in terms of short term, there is a downside risk. I think once it hits July, peak demand season, then we'll really see the big picture. Right now, it's just a lot of speculation going back and forth. I personally did start shorting oil. But again, you got to watch the stop loss. 120 would be the highest point I would put it. Lower point would be maybe 115. But again, this is something to continue to see. Once it starts fall and it bottoms and kind of start rallying again, I think that would be another great opportunity to buy for a bullish or long case. Precious metals, again, expecting new all-time high for gold once Fed pivots. I'm still waiting on that. Still maybe Q3. Again, it really depends how Q2 GDP comes out, and all other factors, like will Fed really have the determination to really lower inflation to like potentially cause a recession to lower inflation? Like, do they have the determination and will? If they do, then the gold case is kind of screwed in the for that. But if they pivot, totally different story. Another thing is for the US dollar index to fall, and I talked about this earlier, where as ECB is also starting to tighten, what happens is that pushes the euro higher, and as a big component of US dollar index, that will put downward pressure on the DXY. And if the dollar starts to fall, what happens is that helps commodities case. Inflation expectation, again, is falling, and positive real yields. These two factors will be headwind for any commodities, especially precious metals, because the financial aspect is such a big part of the pricing. And finally, for agriculture, again, weather impact continues, right? Possibly more price volatility once it's harvest season. Right now, they are at quite high points, and they continue to look bullish. But I would be careful in buying in now, and I would just rather wait for a pullback before buying more. If anyone is interested in the agriculture space, but otherwise, I would just be careful because it is at an elevated point. So there is a lot of risk. Thanks for watching.